we've seen some exciting content today. A number of you are involved in pricing and capacity, and we've heard from several different speakers about both of those things. And our next panel will be on the hardening market. So for those of you on the call, that would be mostly directed at my students. You may not know what a hard market or soft market really means. So let me give you a little bit of background on that. A very, very brief lesson. Is my graphic showing on the screen? Excellent. So the property and casualty insurance market tends to fluctuate. And since demand is relatively stable, it tends to be driven by supply. Now, there's a number of developments recently that may have driven supply, but over time, we have vacillated in this sort of sinusoidal wave that we call the property and casualty underwriting cycle. Keep in mind that every line of property and casualty insurance is different and may not reflect the same factors that another line reflects. So let's talk about a hard market. So a hard market is characterized by high premiums, profitability that's increasing, and strict underwriting. So you saw earlier when we were talking about social inflation, there was an extremely hard market in the 1986, 1987 timeframe as a reaction to jury awards and significant losses from those jury awards. And what the market for liability insurance did in the mid to late 80s was to draw back, to cut capacity, to raise rates, to cancel or non-renew coverage. And that led to a very hard market where insurance was difficult to get. And that was really the true advent of captives. They were born many decades earlier, but captives came into their own as a result of an extremely hard market of the mid to late 80s. Following that hard market, the increased rates and strict underwriting led to a period of high profitability, and people began to re-enter the market, expand capacity. The industry attracted capital, and in so doing, they needed to compete for the business that was out there. And by competing, they lowered rates, they relaxed underwriting standards, and that led over time to a soft market. And so there would be lower rates, increased capacity, more competition, and the cycle would repeat. Well, since the sort of September 11th events of 2001, there haven't been too many events or periods of a hard market. Again, there are exceptions. Hurricane Katrina in 2005 led to a hard market in some areas. But the punchline is that we've had an extended period of a soft market, which leads to this conversation today. Recent analysis by Market Scout shows that Q3 rates were up between 1% and 8%, depending on the line, with workers' comp for the first time increasing for the first time in 5 years. So rates are firming across the board. Anecdotally, 1% to 8% seems very, very low compared to what we're actually seeing in the market. If you were here with us this morning for Steve Legg's presentation, Starbucks is seeing dramatically higher rates for nearly every line of their recent renewals. These are very fresh observations, and we are entering very rapidly a hard market, 2020, for a variety of reasons. Not necessarily COVID, although that's contributed, We have had low interest rates. We've had increased catastrophe activity. And there are other reasons. So that sinusoidal wave that you saw may be headed back to a hard market. There are a variety of thoughts on that. So the textbook says it's time for a hard market after many, many years of a soft market. So what's really happening today? Joining us today are three experts from three different corners of the insurance industry. Morgan Anderson is Area Senior Vice President in Arthur J. Gallagher and Senior Director in Gallagher's Real Estate and Hospitality Practice. Morgan holds the CPCU and ARM designations. Scott Carpenteri is Senior Vice President for Risk Solutions America at Swiss Re. Scott is an associate of the Casualty Actuarial Society. And finally, Rick McCatherine is President of Hippo Insurance, which, as I'm sure you know, is an insurtech personal lines carrier in the homeowners market. Rick holds both the CPCU as well as the CIC designations. During the panel today, I've asked each to give a brief description of their industry experience and bio, as well as their current role, prior to sharing their general observations about what might be a hardening market and why it is such. Each panelist will have about 15 minutes, and then we'll field questions from the chat at the end of the comments. Going in alphabetical order, we'll start with Morgan Anderson of Gallagher. Morgan? Morgan, I'm not sure we have you. I had this problem earlier. You're not muted, but you may have a microphone issue with your computer. I'm very sympathetic because I had the same problem earlier.
How's that?
Oh, now we have you. Great.
All right. Excellent. I will, obviously my technology, other than my fancy background, the actual, isn't the best in terms of my actual microphone. So I will just try and speak loudly so folks can hear. Yep. That's what I was trying to speak up louder if I can. Is that any better? All right. So yeah, my background being that I was in the, have been in the industry for roughly almost 20 years, and have been at mostly larger brokerage houses. Spent a little time at Aon, as well as a little bit of time now where I am currently, most of my career at Gallagher. I am originally from Southern California, was involved in the CPCU chapter, Orange Empire chapter, for several years, but have recently relocated to Dallas. So I am kind of an insurance pedigree of sorts. Grandfather and father ran a regional brokerage in Southern California for about 40 years. And so I tell folks I'm either was destined or doomed to be in this business. I haven't figured out which yet, but I have a lot of fun regardless. If I thought about, David, some of the things that we talked about on our pre-call, and before I jump into all of that, I do want to say just a brief thank you to you and your team for having me on, as well as to both Richard and Scott for letting me join them on the panel today. But really kind of as I thought about the hard market, and I think your slide was very good in regards to the way it's set up, really what some of the issues are that we're facing. And again, my view here will be coming from the broker agent side of what of the insurance continuum, if you will. And really what I think the issue there is, or what I think is causing this hard market, I'll go through in a second. But what I really wanted to kind of hit on was that I think those terms, hard market and soft market, are certainly applicable here. But I think one that I've begun to use and I've heard some other folks use as well is a transitional market. Because I think that when we think about a hard market, we think about all those factors you mentioned on that kind of sine curve, if you will. But one of the things I think really is a defining factor of a hardening market is what you mentioned, which was capacity. And I think that capacity is something that right now, especially particularly on particular industries as well as particular lines of coverage, is becoming an issue. Meaning, it's not enough that someone can write a check for whatever the premium is. It's the ability to even buy what they're trying to buy. So that becomes an issue too, that I think the insurance buyers are having to consider for the first time in several years. And I'll touch on that a little bit later when I make some comments in regards to the excess liability in particular. But I think that some of the issues is that we are seeing right now, or what's my take at least on why I think we're seeing this as hardening, is a bit of a perfect storm of sorts. And really what it was is that, as you mentioned, there were several different influences that have kind of got us here, none of which are the obvious ones, the layups, if you will, which would be, the pandemic and COVID-19 and whatnot, but really the issue of pricing and the way that carriers were pricing to remain competitive within their specific, niches and industry groups and whatnot, was at not an unsustainable place. It wasn't something that I think ultimately you could do forever, because at some point claims will catch up with you, as well as other competitive forces and within our marketplace are going to require that you're going to need to make a move, unless you're one of the extraordinarily lucky that is able to write a whole bunch of business and not be affected by that little thing we call losses. So I think that that is something that where I do believe we are transitioning towards definitely a hardening market. I just pointed that out because I think a lot of folks consider expensive or high rates as being hardening. That's not necessarily the case in a technical term. It really has to do a lot with capacity as well. But I think ultimately we don't see this slowing down, frankly, this year. And I don't have a crystal ball, but I don't think I don't know that it's going to keep rationing up as high as we think it may be, where it is now into 2021, but I don't think it's going to go the other way next year. It's going to be a while until I think it dips back the other way. And from a buyer standpoint, they hope that's sooner than later. But I think certainly from those of us involved in this, those buyers, we should strap in, as they say. For your students that are, as you mentioned, that are probably listening to some of this, this is a phenomenal time to be in the business, because a lot of folks who've been in the business long enough are not simply may never have seen this term. Folks that have been in the business for decades at a time, they've been through a few hard markets, and this tends to be a bit of a badge of honor, so to speak. That they really kind of say, "Well, I've been through X amount of hard markets," and because you never really understand that until you go through one yourself. So this is again an exciting time for sure. But to kind of hit on a few things here that I think are really contributing to this, and again, some of these are obvious, but a lot of this input that I'm going to provide is driven from what our clients say, as well as just observations we have in the marketplace, talking with carriers and also talking with those who are buying it, our clients, as well as our colleagues and whatnot. But obviously, COVID-19 having a big impact. I don't think necessarily from a claim standpoint, because so much of that is being still playing itself out, and it will for a long time. So that's not something that I think we're seeing effect on pricing, other than I think we're seeing it from a global economic uncertainty of what COVID is going to really do. When does it end? Is there a vaccine? What does it look like? What's the efficacy of that? All of those kind of things no one knows. And so that is certainly a problem in regards to some underwriters and what the carriers have to do to try and plan for that. And so I think that's certainly causing an issue. I'm not even going to attempt to dive the reinsurance market. I'll leave Scott to explain that, because he is much smarter than I in that respect. But the impact it's had on them is the reinsurance market is certainly unique. But again, that is something that's having an impact. Storms and wildfires. Those are newsworthy. This is the second most active hurricane season since 2005 in regards to the number of named storms. And I know that everybody may already know this, but literally the National Hurricane Center ran out of names, and they had to go to the Greek naming system, which is only the second time they've ever had to do that in history. So when they run through A to Z, all the funny names they give the name storms, they start over and start with the Greek alphabet. And they obviously, if they get through that, it's not good. So that is certainly having an impact on this is property pricing for sure. But more to the point, though, is that a lot of those losses, thankfully, have not been catastrophic. And I say that with all sensitivity to any of the folks who've actually been through it. I mean, purely from an insurance standpoint, that the issue there of why we think that continues to harden some of the property markets is because those primary carriers are really taking the brunt of this, of the losses, which they would anyway. But really, there's no the overall loss really isn't a participation in some of those higher excess layers, or maybe even some of their reinsurance at that point, simply because those catastrophic losses have just not been as large as we may have expected them to be, which certainly puts pressure on their overall combined ratios, and obviously has its effect rolling downhill in terms of a pricing standpoint. I think also wildfires. Wildfires are something that the insurance carriers have been working really hard to try and address. So much so that if you got things property in a brush zone, going to be an issue in terms of trying to get that covered. I think in particular, I'm sure that Richard mentioned this as some comment about this as well. High value residential homes in some of these areas that are in these hills and these brush areas, particularly hard hit. And I won't go into that. I'll leave it to Richard, who's the expert on that, to talk about some of that. But that's an issue as well that is driving some of this hardening. Specifically on providing some other insight into some other coverages that are particularly difficult to place right now. Builder's risk. If you've got a wood frame project that you're trying to place right now, and it's of any size, meaning anything 50 million and build costs are higher, it's no longer a single carrier solution. It's going to require several carriers to get involved. Again, another side of a hardening market, not enough capacity and to get those projects done unless you're putting 3, 4, 5, 6, maybe sometimes 10 carriers from my kind of a shared layered standpoint onto a risk is become the norm now. Anything that it's got a project of any real size, that's just an accepted. I would say also you're finding issues as well. Kind of what got us here. I thought about that a lot after we talked, and the issue was what did get us here? How did we find ourselves in this situation? And I think part of it, from a property underwriting standpoint, is that in not pointing any fingers anywhere, but valuations were probably not where they should have been in regards to replacement costs on a fair amount of things. And I think that was something that ultimately creates claim creep, and we can certainly get into that some other time. But I think that was a big piece of it as well. The liability side's not unheard on this. They actually are seeing some of the larger capacity issues. Like I said, excess liability is a big one, and excess capacity right now is difficult to find, especially anybody trying to place a large tower of say $25, $50, $100 million plus. That is not uncommon to see folks placing half of that limit this year, and for 2, 3, 4 times the price that they paid for the entire tower last year. Again, another great sign right there of a hardening, difficult market is not being able to buy as much as you did previously, but paying more for that smaller amount of limit. So those kind of things are all issues I think a lot of our clients out there are looking at. A lot of insurance buyers are having to deal with. And I think for my last comment would be that I think that one of the things folks are having to look at in terms of, I say that casually, folks, insurance buyers, is to say that why did you buy the limits you purchased previously? And if it was simply because you could, which by the way, a lot of folks did buy those kind of high limits because they could. Now they're having to relook at that and put a little more, thought and science behind it and strategy, because frankly, the limits just may not be there when they need them.
Great, thanks, Morgan. That's very consistent with the message that Steve Legg of Starbucks mentioned this morning, that it's taking more carriers to get the same done, and rates are in some cases doubling. And so, a very consistent message. So, Scott, you're involved in primary insurance, yet at a reinsurance company, yet you have some reinsurance experience. Sort it out for us.
Yeah, thank you. First off, audio coming through okay? Excellent. Yep, great. Yeah, so I wear this crazy headset because it seems to work better. So I do look like an air traffic controller here when I'm not doing insurance work. So thank you for the invitation, David and Morgan and Rick. Really nice to join this panel with you. To all the audience, nice to see the number of people here. It's fantastic. It's really a very, very timely topic, and very happy to lend sort of my perspective and experience and expertise. Just a little background on myself, as David had said, I am an actuary by training, so don't hold that against me. And I have been in more of a deal role for longer than I can remember. So actuarial background, but more frontline person. So got a bit of a hand in each pot, so to speak. And in addition, I've also served on the treaty side of Swiss Re, so the big reinsurance, that mysterious part of the insurance industry where those, all your favorite insurance companies, for various reasons, there are elements of their risk profile that they actually send off to another company, and that's where reinsurance comes into play for the students on the call. And then I work in the insurance side of that reinsurance company. So I'm in a very different corner of the world than I once was. So work a lot with commercial, mid to large commercial insurance, public entities. So that's the space that I participate in right now. And so when you think about what's going on in the market, absolutely haven't heard a thing yet that I have any different perspective. I think the sine wave is a perfect way to illustrate it for those that are newer. In fact, for everyone, quite frankly, because I think we see the change and we say, holy cow, hard market. And I liked that you called it hard and hardening market. I think you called it actually a hardening market, because we're with the magic. It would be really great if you knew exactly where you were on that sine wave, just sort of like stock markets and other markets. You just kind of know where you are relative to where you were yesterday. So if you think about that sine wave, we are on the upwards part of it. We're fairly certain that that's where we sit. Are we in the above water part, as that very important line was, or are we still below water but charging more than we did last year? Or are we way up in the toppy top part, theoretically, if it exists? And I have an opinion of that. So yeah, that's the secret and the magic. We don't know. So my perspective here, and what I wanted to kind of add to this dialogue, is a little bit, I think where Morgan had left off is, how do we get here? And for the folks on this call, I have lots of expertise here. I know a lot of the folks here being underwriters and CPCUs and people in various aspects of insurance or pursuing insurance. This is all going to be very basic, but I think sometimes you want to jump back to the higher level, the bigger picture, and the basics. So one of the things that's really important to remember when we're in the weeds of insurance here and saying, oh my gosh, these prices and the capacity and what's going on and the carriers, this is one of the most rare products on the planet. And in fact, I can't really think of many other products that when you sell the product, you actually do not know your cost of input. I mean, it's a really fundamental thing that we all know and probably don't think of that often and take for granted. But this product, we don't know. Certainly, any individual policy, that truth will reveal itself over time. From the carrier side, our job's to figure out, okay, well, on average, what the heck should that right price be in those right terms and conditions? Because this ecosystem needs to stay fairly imbalanced, ideally year to year, but at least in a sort of medium to longer term, this thing's actually got to be predictable and generate some returns for the shareholders that are putting capital at stake. And that is not an easy task, even normally. Like, forget market dynamics, figuring out what the heck a piece of insurance should cost, and the folks at Hippo are trying to look at that in a different way than the industry has ever done that before, and maybe put a new spin using tech and everything to maybe get more consistent answers than we have done classically. But that challenge with the earth sort of throwing things at you left and right from a risk perspective, whether that be natural catastrophes, climate change, increase of severity and frequencies of catastrophes. Oh, smaller things that used to not be such a big deal, but now are a big deal now, what we call secondary perils, hail and flood and all these different things. All of these are just creeping up. In addition, you look at the societal stuff. So we look at liability and casualty. Uh, there's medical inflation is huge in the US. And so a lot of liability has to do with injuring people. So that is a fact that has been around for quite some time. You look at CPI, index, and, inflation's about 2%, 1%. You look at medical and it's a different creature altogether. Well, that is fundamentally impacting insurance. And where does that show up? It shows up in the losses. And then you have, David mentioned, in the 80s, there was a sort of jury verdicts, what we may call from our side runaway jury verdicts. I mean, there are now claims that are having at least preliminary verdicts of $1 billion for a single claimant, not a class of people, a single claimant. I mean, how on earth does one try to? This isn't magic money, as we all know in this group, but the outside world sees insurance as just free magic money, but it is paid by everybody. And so how do we keep those things in balance to get the right price? It's very, very difficult. So you're selling a product that you don't know the price of when you sell it, and it's a very competitive industry. There are a lot of players. Now, maybe fewer players in a particular piece or line of business than there were a couple years ago, but it is still a very competitive industry. And so what we face on my side of the table from the carrier, the insurer and the reinsurer standpoint is, you know, the chain is only as strong as the weakest link. And then, so I'm not pointing fingers or anything like that. It's just a reality. In insurance, generally, price prevails. You turn on the television and nobody's talking about, oh my gosh, we have the best claim settlements. It's price, 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 price. Did we mention price? Right? So price prevails. So the whole industry is priced at the level of, for lack of a better term, the most drunken sailor. And the product you don't know the cost of. And you can tell yourself all kinds of fancy stories about, I bet you it'll be better this time. That was bad luck last time there was a claim, and et cetera, et cetera, et cetera. And some of these lines of business, you don't know that truth for a very long time. So you can actually tell yourself lies on the insurance carrier standpoint for years and years and years. And you think of it like a spring that just keeps stretching and stretching and stretching and stretching. And then one day it retracts or snaps. And that's what you face when you find those very steep changes in those curves. So it's a horrible situation. It's unfortunate because there are people on the other side of that. There are buyers on the other side of that whose lives are impacted by trying to, I mean, first of all, needing insurance, insurance for the stability of their organization, and then trying to manage the budgets. It's nice when you get big breaks, but then, if it comes back again and, 50, 80, 100% rate increases, how the heck do you predict that? And so these are very, very challenging. And so we feel, I mean, for on my side of the table, on the risk-taking side of the table, we feel for everyone. If there are risk managers in the group here, I know you saw one this morning. This is not how we want the business to perform, but the market sort of becomes its ecosystem of its own, and no one player can really control it. And so we have these cycles where I think, my personal standpoint, being an actuary who's been in underwriting roles, who has focused very much on the technical side of the business, that yeah, you can kind of tell yourself some stories from the risk-taking standpoint, and you can maybe undercharge and overpromise on terms and conditions, and that eventually, when it comes back around, this is where radical changes start to happen. And again, very, very painful for the folks on the other side. I'd just say, it we've not done ourselves a service, and this I'll speak sort of on my end of the table, and the intermediaries as well, not Morgan specifically. I'm sure he managed all his clients very, very well. But You what other cost of any business is just goes down year over year, and that's what we trained over the last decade the insurance industry to expect. I mean, up until a year, 2 years ago, it was, okay, how much are you going to cut off my price this year? And then Morgan's in an industry where if he says, guys, this is you're getting a really good deal, your exposures are going up, you're building new buildings, you're adding new business to your business model, that's kind of the thing. Morgan's got a competitor right on his heels that'll say, oh, Morgan's full of it, I'll get you half the price that Morgan will get. So every aspect of this industry is so hyper competitive. And again, the truth is a little bit harder to suss out and wasn't known for more of a period of time. So I'm not saying anybody's overtly untruthful, but you can be more optimistic, let's say. And so you have all these things coming together to create this crazy market cycle. I will say, in speaking to so many CPCUs here, this is where underwriting is so important. I think where I think Morgan nailed it. Like, okay, pricing is one thing, but the capacity, the fact that you used to be able to buy $50-100 million of insurance, and now all of a sudden you're cobbling together 25 million, and you built your organization and your whole financial side of your organization around the fact that you won't be retaining that portion of that risk. Somebody else will take that, and you're going to take the smooth portion by paying the premium. It's one thing for the premiums to fluctuate, which is trouble enough, but having that limit, that available insurance fluctuate wildly, now you're talking real money. And so I'd say from this group standpoint, just an important part of that is, underwriting integrity. I mean, if the more solid underwriting we put into the products, throughout the whole market cycle, I feel like there's a better chance we can maybe, well, I don't know if we'll ever stop the market cycle, although maybe Rick can figure out how to stop it, but we'll maybe make those peaks and those troughs not so pronounced and make it a little easier for folks to handle and deal with. From our standpoint, this is what happens, and it's a tough reality. You start getting really soft terms and conditions, so pricing becomes maybe less than what it should be, and then you start doing throw-ins where, okay, usually these are excluded, these parts of the policy, or usually have big deductibles just to kind of manage the loss experience on a certain part of a policy, and those just start getting chipped over time. And those they're kind of, you can act, they feel like free throw-ins because it's just words on a paper. It's not even part of the premium transfer until the claims come. And so what happens is, from the carrier standpoint, if you're doing things that you've not underwritten well, then when the claims start coming in, it's when the carriers start freaking out and they just want to shut things down. And then you have that situation that Morgan described, which is, holy cow, how do we keep this going year on year and allow the clients to buy these limits? I will say, from a carrier standpoint, the more thorough the underwriting and the pricing was to begin with, I'd say the less likely there is that sort of whipsaw of pulling out of the market. So again, nobody in this group has this single ability to change that, but I think collectively, I think we can all sort of help ourselves just do a thorough job, because there is in the actuarial world, we call it parameter risk versus process risk, right? So process risk is, there's a roulette wheel, the ball lands on 00 and you lose. But you know what? That's the game we're playing. It's risk, right? We're taking on risk to help the individual client. If they have a good or a bad outcome, they're going to have the same experience, just the one premium. And we on the insurance side are taking that volatility. There's going to be volatility. People will have claims. The parameter risk is, did you price that roulette wheel as though it had 1,000 spaces and there was a 1 in 1,000 chance of hitting 00? Or did you price that as it was 36 spaces, right? And those are the things that sorry for the actuarial angle here, but that's the way. So we try to parse things out. It's, hey, if a client has a claim, or if a book of business has experience, is it something that we thought through? And is it something that we feel like we had the appropriate probabilities on and we charge appropriately? Then, you don't have to freak out as badly. If it's something that happens that we oh, we never even considered and never priced, well, that's when things get crazy. So wildfires is a perfect example. I mean, the wildfire risk has changed radically, it seems, over the past several years. Uh, what is the right price? What is the right way to handle that risk? Wow, that's something that's being evolved. And quite frankly, I mean, it felt to me like it was a throw-in up until now because there occasionally would be a wildfire. Last maybe 3 to 5 years in California has been a bit of a wake-up call. But even then, the first couple years, you get a little knock in the face and you go, oh, that was an anomaly. Don't worry, it was an anomaly. And so now you get to the point where, okay, this is happening more frequently. And so maybe when you look into the future, this may be our new normal. All things that a lot of smart people have to try to figure out. Um, so yeah, and then from just one comment on the reinsurance side. So the reinsurance is sort of, almost think of reinsurance as a derivative of insurance, not in a cable news sense, but in a pure classic definition of derivative, right? So the insurance market is where these things are happening, where terms and conditions are being negotiated, prices are being negotiated, and then the reinsurers are sort of beholden to that. They're charging their piece of the puzzle of the risk they take on, but a lot of what's going on underneath is sort of driving them. So there is a sort of back and forth relationship between the regular insurance market and the reinsurance market, and a lot of very interesting dynamics. But the reinsurance market also has a cycle, just like David had shown. Sometimes just shifted from the traditional insurance cycle, sometimes for other reasons on its own cycle.
Very good, Scott. Thank you for both the primary and the reinsurance piece. And transitioning to personal lines and InsurTech, Rick, I know you're joining us having just come from another conference, so you're bouncing from job to job to job. Tell us a little bit about yourself and what Hippo is for those of us who don't know, and then how personal lines might fit into this hard and soft market cycle.
Yeah, thank you, David. Just want to make sure, can you hear me clearly, everyone?
Yes.
Perfect. So first of all, I want to thank David, Scott, and Morgan. David Russell is one of my absolute favorite people in the insurance industry. So if any of you are students of David, you should count your lucky stars, because despite David's shall we call it stoic personality, there's an entrepreneur under there. So I've known David for quite a few years, and he's absolutely one of my favorite guys. I'm going to do something different. I don't know if David's going to invite me back, though. I agree with what Scott Morgan had to say, and I don't want to parrot the same comments. So first, though, I need to frame up a little pedigree, because I think what I say could easily be dismissed if you didn't understand where I'm coming from. So I've been in the insurance space 27 years post-college and a lifetime pre-college. So I grew up in an agency family, went to college, knew I wanted to get into insurance, and started as an underwriter for a California-based insurance company. And I spent the next 27 years on the underwriting side, the operational side, the marketing and sales side, really everything. Been a CEO 3 different times, as David mentioned. I'm a CPCU and a CIC. I live, breathe, and will die an insurance geek. That said, I think I have a different perspective, working in what I think is the shift and change of the insurance industry within InsurTech. Now, I will say InsurTech has wide connotations. What does that mean? Are you providing technological services to incumbent insurance carriers? Are you providing new user experiences for direct-to-consumer customers? Are you working with agents? Are you working with partners? Are you underwriting? Are you claims? All of those go into the context of InsurTech. Now at Hippo, we are a primary insurance provider in the homeowners insurance space. We wrote our first policy 3.5 years ago. We now have several 100,000 customers writing several hundred millions of dollars of premium in 33 different states. California is one of our larger states. Our corporate office is in Palo Alto, California, which is where I'm sitting right now. The difference between what I would consider winners and losers within the InsurTech space are directly related to this comment. InsurTech is made up of 2 words, insurance and technology. And unless you put equal energy and emphasis in both, you will fail miserably, period. If you're an insurance guy that says, hey, I want to do this new cool tech innovative thing, but you're an insurance guy and you have no idea what customer expectations are, you're just going to create the same old thing that's been created for the last 30 years. If you're a technologist and you say, I need a better user experience, I need to make sure my customer can get a quote in 30 seconds and bind a policy in 3 minutes, unless you have insurance fundamentals behind it, unless you're thinking about things like reinsurance, retro insurance, risk taking, how you handle claims, you're going to fail miserably. On the other side, you're going to write a lot of business, and then the reinsurers are going to say, you're done, because they're the ones that are bearing the risk. And I think you see that in InsurTech today. I think you see both industry and investors picking winners and losers in this space. And we're fortunate at Hippo that we've been identified as a winner within the property space, which is dramatically impacted, obviously, by hard and soft reinsurance markets. So there's a couple things that I want to touch on related to reinsurance. First of all, I think Scott's an incredibly bright guy, and I really agree with every comment he said but one. The one comment that I disagree with is I do not believe it's all about price. I think if you continue to focus on price, you will ultimately lose, because every carrier out there, or MGA, if you're an MGA, everyone out there will have somebody selling a product cheaper than yours. So if you're trying to focus on price, you will never have a positive underwriting result. Instead of focusing on price, I suggest we as an industry shift the focus back to the customer. Understand what the customer needs and how can you achieve a better outcome? How can you create a better product that breaks this shift of hard market, soft market, and to Scott's point, flattens out the curve a little bit? That comes with innovation. Nobody is ever successful if you just copy somebody else in the long run. Yeah, you might get some short-term solutions, but we're in an industry full of lemmings. Every one of us copies everybody else. So unless you are constantly innovating and constantly changing, then you're going to find yourselves reliant on the lowest common denominator, which is the lowest price sales, instead of creating that value add that the customer actually needs. And I think we as an industry have forgotten there is a customer at the end of this, right? We as an industry call our customers insureds, right? Think about that for a second. It's like people are grateful that we will allow them to buy our policy. That's just crazy, right? And some of the younger ones of you that are out there are going, this industry is broken. I don't think it's broken. I just think it has failed to modernize as other industries have. The experience needs to look much more like an Amazon purchase as opposed to company XYZ purchase. See, David thought I was going to get in trouble there and call somebody out. I won't do that. But I think it's super important to recognize the customer comes first. And you can create win-win scenarios with customer and with underwriter. Let me give you a few examples of that. Anybody that buys a home, they need homeowners insurance. You can't close the loan without homeowners insurance. So what most people do is they'll call an agent, and the agent will ask them 70 questions that they likely have no idea how to answer. How close are you to fire hydrant? I don't know, I've seen the house twice. What's your inner wall material? When was your roof replaced? Was the bathroom downstairs a 3/4 or a half? 70 questions that you just don't know how to answer. But every insurance company out there requires the customer to answer it, and they get an answer, likely wrong. So now what we've done is we've created friction in the customer process, and we have created a subpar data collection stream, and we have wrong data, and we are underwriting against wrong data. So why don't we use verifiable third-party data sources that we know to be accurate and eliminate those questions from the user experience? So oftentimes my underwriter friends will say, Rick, how do you know you're going to have a more profitable underwriting result when you don't ask the same questions that we ask? My response is, oh, I ask the same questions, I just ask them through a verifiable data source, including things like real-time aerial imagery that truly tells me how that risk shifts and changes over time. And then I work proactively with the customer, not just at new business and not just at renewal business, to try to make sure that we are, from an ongoing perspective, staying very relevant to them as our customer, to them as trying to do what we do best, which is protect them. And oh, by the way, trying to have the best claims experience, which isn't you show up the next day with a check in your hand. That would be a great claims experience. None of us do that. That would be awesome. But what's even better than that is you help that customer avoid the claim entirely. So what can we do? What can we use and do with new data sources, with proactive home IoT devices, home protection devices? What can we do on risk segmentation, on pricing segmentation? All of these things to completely shift the paradigm to where it's less relevant if it's a hard or soft market. It's more relevant that you have a better underwriting result that has impacted the customer positively, because there is plenty of capital out there and plenty of reinsurance capacity for programs and carriers that have loss ratios in the 40s. Where the capacity dries up and freezes up is when your loss ratio is in the 90s, right? People will be clamoring if you shift the paradigm and rethink the way that we underwrite policies, the way that we get data, shift the entire paradigm, shift the entire way that this industry does business. And this is coming from a guy that when I started in a personalized carrier, I was writing memos to agents in carbon copy. I was manually rating car insurance policies, right? I mean, I've been there, I've done it, but we have to think differently. And for those of you that are students or trying to get your CPCU, get your CPCU, because you have to understand where we came from before you can help innovate and change where we're going. And I got to tell you, from a young person's perspective, and despite my youthful appearance, I'm not that, it's an exciting time. The use of data, the use of technology, machine learning, AI, all of these things are making insurance sexy. And I don't think any of us that have been around for more than 20 years would ever call our industry sexy. I'm telling you, some of these new cool insurtech companies and some legacy incumbent carriers that really get it, they're all living into this this idea of we have to adapt, we have to modernize, we have to show continual improvement, both from a tech side and from an underwriting side. So is the market hardening? Absolutely. Why is it hardening? Lots of different reasons were discussed today. Weather patterns are changing, and I'm speaking specifically about homeowners insurance and property insurance. Weather patterns are changing. People are building homes in buildings where they used to never build homes and buildings. Regulators, it's becoming more politicized generally. Now, that said, I have found that when we talk to commissioners and deputy commissioners, they're customers too, and they want to be a part of something new and innovative. We've actually found them to be great collaborative partners if we can clearly articulate what we're trying to do, which is fill their three tenets as a regulator. Make sure our rates are adequate, so not the lowest price always. Make sure our rates are not unfairly discriminatory. I think we'll all agree that we need to do that right. And the third is make sure that we are essentially protecting the customer, right? So these are the kinds of things that collaboratively we can do together. And we've got to look forward, but recognize the history of the past so we don't make the same mistakes. I'll share one final thought with you. The way I look at the insurance industry, it's like driving down a 3-lane highway. And 3 lanes, emergency lanes, guardrails. Most what I'll call older insurance company people tend to drive down the middle lane all the time, 100% of the time. They forget there are 2 other lanes that you can go back and forth in. In fact, occasionally there's an emergency lane that you may want to swerve around to take advantage of something that is truly new, innovative, and sort of changing for the industry. There are certainly guardrails that you absolutely cannot bash into. Those guardrails include things that are irresponsible pricing, forgetting that underwriting matters, forgetting that policy coverage and forms matter, and forgetting that this is a highly regulated industry and we've got to do right from a regulatory perspective. Absent those guardrails,
take advantage of the full 3 lanes, do things that are different and innovative. And I think people that are interested in CPCU are interested in pursuing their career, interested in being part of something special and something different. This exists in the insurance industry now. And I got to tell you, I'm super excited to be a part of it. So thanks for having me, David. I'll stop there.
Sure. So Rick, I'll circle back to you. You're in personal lines, and there are more units, and they're more sort of standardized, and the databases might be more developed for personal lines and homeowners than they are for a large hotel, or some of the developments that Morgan's on, or some of the unique risks that Scott probably sees. Do you think that there's a middle ground? I know you've spent most of your career in personal lines. Do you think that for large commercial, not small commercial, but for large commercial, some of these same principles can apply, or is it a little more complicated?
It is certainly more complicated because commercial exposures are always more complicated than personal exposures, personal lines exposures. That said, many of these technologies and industries can absolutely take advantage of the changing sort of technological and data improvements. Look at some of the telematics companies are doing, not just for personal lines, but in commercial trucking. Look at what you can do from aerial imagery on a real-time basis. Look what you can do from loss mitigation by interior devices that used to cost, tens of thousands of dollars to install. Now you can go down to Best Buy and get a DIY kit that can tell you, that can provide you smart water leak detection devices. Is it more difficult? Yes. That's why we need to continue to innovate. And all the data sources are not insurance data sources. There are data sources for all different purposes. The trick, the secret sauce, is finding a unique data source that was intended for a very different purpose, to transition and shift that into a way that you can utilize that data and that information and apply it to insurance, whether it's commercial or personal lines.
Morgan and Scott, what are you seeing in terms of innovation? And as Rick mentioned, and you guys were talking about, the good old-fashioned underwriting, there's no substitute for that. But in terms of innovation, particularly Morgan and Scott, you both see these one-off major developments. You see some very large risks that require a lot of capacity. What are you seeing in terms of innovation versus sort of old school underwriting?
Yeah. So appreciate the question. So Rick, I echo all of your comments, and I couldn't agree more. And by the way, we don't even disagree on the price thing. I was just saying that that's the reality that's out there. I don't agree with it, but it's hard to avoid it. So yeah, and I'll dovetail on what you said about the data. Like, I couldn't agree more. So in my space, what I do, so I'm in a corner of the, we got the reinsurance and then the insurance arm of the reinsurer, and then I'm in the specialized arm. So my team is challenged with one-off unique risks where clients cannot find a solution, and is there a more clever way? So we are literally just carving new paths through the jungle on my team. And one of those places that we are having an amazing amount of success in, which really dovetails nicely with what Rick was saying, is what we call parametric insurance products, where we say, okay, let's not go through this 18-month claim settlement process to figure out that we owe you $100,000 or whatever the case may be. Can't we just all agree that if there's a major hurricane or a major earthquake, you're going to have some problems and we should just cut you a check? So we're using that data, Rick, on the claim settlement side as well. So I couldn't agree more. And so our earthquake product is using USGS data. These guys produce detailed footprints of where the shaking was, and we all pay for it automatically anyway. So we can actually harness that. They are the world's experts in earthquake science. So let's just use their work and use that to quickly and efficiently settle some of these more unique claims, for the folks that want the parametric solution. So yeah, I think that to me, that's where innovation is the true part. And I am on an innovative team. Classically, and Morgan, I'll toss this one off to you, because when some of the brokers, the not as good brokers, so this isn't Morgan, this is the other brokers, right? They'll say, when they say we want you to be innovative, they usually mean just write it anyway. It's not necessarily rearranging the cube at all, right?
Yeah, what probably should have been said there was really was write it anyway, or just take a risk. So get rid of saying innovative and just say just take a risk, would you? You know, it's kind of what we're really saying, I suppose. But yeah, and I would just say, David, in regards to the overall technology or any type of innovation, I think in terms of some of these larger projects, as you mentioned, that we're looking at, it really comes in the form of some of what like what you said earlier too, in regards to having the two sides having to meet, technology and insurance. And I think that really from, again, my personal background being in real estate and hospitality, specifically, some of the larger projects that we're seeing is a lot of technology actually being used in regards to how carriers and are able to underwrite more than just what they're looking at in terms of a statement of values or a spreadsheet. They're able to actually say, hey, we do want to see some of the whether it's like Rick, what you said, some of the aerial imagery. They actually look at what am I actually dealing with in regards to an actual a project or an actual existing structure, as well as looking at a hot topic right now of builders risk is having full, effectively almost 24-hour security, either a watchman service or some kind of a monitored video surveillance system, which 10 years ago, if you'd have said monitored video surveillance system, people thought you were crazy, but now it's something where there are multiple firms out there that have come up with solutions for our clients, our buyers of insurance, to be able to satisfy that requirement, to help underwriters be able to say, all right, get a different level of comfort so they can look at a risk and be able to rate it a little bit more appropriately, or as brokers and agents say, rate it more effectively. But nonetheless, those are some of the innovations that we've seen, just off the cuff in regards to kind of project insurance and what some buyers have available to them.
So we have about 5 more minutes. I'd like to get a little bit of crystal ball gazing out of all three of you in terms of your perspective on rate, availability, capacity going forward. I know there's the push for rate across pretty much every line, and the question is, where does that sine wave sort of peak? They don't ring a bell when it hits that peak. But Morgan, I'll start with you. How much worse does it have to get, or are we just normalizing and we'll overshoot? What are your thoughts on sort of where the pendulum is?
Well, as an industry, we're huge fans of swinging too far one way or the other. We seem to have perfected that art, actually. And so I think that ultimately, again, if I'm being Karnak here and trying to answer your question, I would say that I think that going into next year, as I said earlier, we're not going to see a level. I would say we'll see, I hope, a leveling next year. I don't think we're going to see the sine wave dip back the other way in 21. I think that you're probably going to see it's going to be into 22. I hate to say it. I think where we're still going to see maybe some of that leveling, maybe start to taper. But quite frankly, we didn't get in this thing overnight, and so we're not going to get out of it overnight. So I think that's something to be fair as well to to the underwriting part of the world too. But that'll be my comment, that I think that ultimately, yeah, we're going to see. Probably aren't going to see any type of real material leveling, if you will, or kind of coming down probably until 22. And that's, hopefully, I'm not being optimistic, but that's what I probably think you're going to see.
Scott?
All right, so no crystal ball from me, but I'll give everyone a secret. I'll let them in on a tip. So if you want to try to predict where this might be going, and if you're not only an insurance nerd, if you're a bit of a finance nerd, look at the results and the annual reports from the public insurance companies. Look at the reserves for the old years. If they're still adding reserves to the old years, market's not going to get finished hardening anytime soon. If they've started to finally stop adding reserves to the old years, there may be that things have caught up, and to Morgan's point, maybe overshot a bit, and then the optimism may start to increase again, and that goes in the other direction as well. So if you look at the earlier years of this soft market, so maybe 2012, 13, 14, or even 10, 11, 12, the mid 2000s were actually particularly from a liability standpoint, there was a lot of reform that happened, a lot of judicial reform, a lot of tort reform, and those didn't come home to roost for a while. And so, well, they happened, but you just didn't know for a while. And so, the companies were releasing reserves for a number of those years. So you can kind of get the profits on the back end and not have to worry so much about the front end. Watching sort of, and basically it's like shaking the piggy bank, right? So if they can get money out of the piggy bank, soft market's probably going to do okay for a little while. If the piggy bank starts to go dry, watch out. And if they start loading the piggy bank back up because, ooh, the piggy bank like didn't do very well, and that's the reserves, the old reserves on early years. Those are a little bit of a canary in the coal mine that you can look at.
That adverse development from prior years is that indicator. And Rick, I'll give you the last word.
Yeah, look, I think that's really intuitive, Scott. I think that's right. The problem is we're reactionary, and we're reactionary because of volatility. And as long as we're reactionary, I agree with Morgan. We're like the absolute best pendulum swingers. Either insurance or politics are the absolute best pendulum swingers. We always go too far one side, too far the other side. The challenge becomes, can we get reinsurers? And let's not forget the concept of retro insurance may be new to some of you. Reinsurers insure primary insurance companies. Retro insurance reinsures reinsurance companies, and they all kind of buy each other's portfolios a little bit. So we at Hippo, we partner with 12 different reinsurers on our portfolio, and Scott's company, Swiss Re, is a great partner of ours. There's plenty of capital if we can find a way to curb the volatility a bit. And I don't mean the volatility of losses, I mean the volatility of earnings patterns. Because what happens is you lose a ton of money for 3 or 4 or 5 years, you overcorrect, then you make a ton of money, and it creates this massive shift. So alternative forms of capital get really, really nervous. If we can sort of smoothen that out a little bit by not overreacting and being a little bit more what I would call prudent, I think what we're going to find is more capital, whether it's ILS or other things, will find its way in. You think about how much money are in family offices. There's just an endowment funds from universities. There's a ton of capital out there. If there was even remotely predictable curves, I think you'd see that come in. And so I think that's something that as an industry, we should try to solve.
Right, a great way to end, sort of getting that capital to the table if it can get some comfort on that. So I'm really grateful. I've used that word so many times today. We've taken a lot of professionals' time and brought it to other professionals, and sometimes we just have to disconnect for a few minutes to share really important information. And I like I'm going to, as soon as the market opens tomorrow, to Scott's point, I'm going to start trading on today's crystal ball reflections. But Morgan, Scott, Rick, I'm again very grateful for the time you've taken out of your day to share with our CPCUs and our students. And so next up, we have California Department of Insurance. I'm going to hand the floor over to Ed Combs.
Thank you, David. Yeah, it's me again. And me again with the same message that this following talk has been approved by the California Insurance Department for continuing education credit.